All right. Let's give that one more. Give me one more moment. Maybe it's coming through now. Don't know. Still no audio. Okay. Huh. Oh, now we're good to go? Oh, now it's working? Oh, okay. I have a camera mic and I have a mic and I have no idea. All right, we can hear. All right. Thank you, gang. Thank you so much. Thank you so much. All right, good to go. Welcome to Top Tier Outlook. We're going to take a look at the week ahead, the week of April 8th. Cannot believe it's April already. So we're going to go ahead and jump into what is going on in this environment. I'm going to move this over just a little bit. Okay, there we go. All right, so we're going to take a look at the indices. Of course, we're going to take a look at your questions, whatever questions you might have. We'll go ahead and do that. And the mic is good. Yeah, mic is good. All right. Happy Sunday evening, everybody. Hope everyone's had a relaxing weekend, especially after the week what we had. If you haven't already checked out any of the free videos that I sent out or any of my sessions in Charts and Coffee, or if you're a Sector Secrets Mastery, this was an update we sent out. I want to mention just a couple things because it's easy to start this week on shaky footing. But what I'm trying to say is don't let Thursday change your plans. Don't let Thursday change your trading plans. Don't let it question what you are looking at overall, because Thursday was a session, a kind of session, if you will, that we've only seen twice this year. And that is a session where the single day, that day's session exceeded the historical volatility probability of 68%. Okay, Rog, what does that mean? That means 2/3 of the time we're operating in what we call historically valid zone of what I call daily price movement ranges, DPMRs. And the first time we saw the daily price movement ranges get upended was back on, you can see back here, minorly so, but it still was on January 8th. Right, we definitely had a moment like that. We could also say the 13th was another one. So really 2 to 3 times this year in total. So 3 months, but at most 3 days that had above average historical volatility. Is that the new normal if we've seen something 3 times in 3 months? Absolutely not. And if we take a look at what's happened, not only Friday, but now here, it's early Sunday. So we have the Asian session kicking things off. We're actually trading higher than we closed on Friday. Is there any reason to change the overall bullish expectation, the probability based on what happened Thursday? No. But let me talk about what does happen on days like that. Trend transitions or any kind of extreme volatility is never going to be pretty. Very, very, very few trading participants are going to be able to take advantage of a day like Thursday. And imagine this. If your trading plan needs a day like Thursday to succeed, congratulations, but there's not going to be that many opportunities to take advantage of really what I call the rare air, 32% probability of price movement range. So congrats to those of you that did well, and congrats to those of you that did what we're supposed to do. Take our stops, protect the downside, take those paper cuts, take those small, yet, I know they can add up, but take those small losses, clean the books out, clear the mechanism, and then move on with what we still have in place, which is largely a bullish environment still. So let's talk about what's happening here on the top tier indicators, because this is really important. And it's an adjustment we all have to make. And I think it's an adjustment when as visually clear as a traffic light, it's easy to make. We can have a lot of confidence in what we're seeing, and I'll tell you what we're seeing. So right in here, this is what we call a wobble. And the best analogy I have for this is if we're all cruising down the interstate, doing the speed limit, of course, and we let off the gas. Does the car turn around and go the other way? No. Does it stop? No. Does it slow down? Do we start to coast, but still at a high speed? Yes. And that's exactly what the equity markets are doing. The foot is off the gas pedal. And the way I know that is based on the green energy, right? That green trend going gray. That's how we know. So we've let off the gas a little bit. But again, Doesn't mean we're turning around, doesn't mean we've come to a stop. It simply means that my expectations for higher highs until the trend reorganizes is lower. But take a look. Even with that dramatic candle on Thursday, did we even plot a yellow neutral candle from our top tier pro system? Not at all. So there's no reason to change what we're looking to do, which is still, if you've been joining me here for Charts and Coffee or Top Tier Outlook, you know we're still looking to buy the dip. But where, right? That's the big question. Where are we looking to buy the dip? And in this week's Top Tier Outlook, which is the newsletter that we send out to Sector Secrets Mastery folks, as well as anyone who subscribes to the Top Tier Outlook newsletter, I started to pinpoint and put a list of stocks together that are under the framework of the Federal Reserve is still going to cut rates. When? That's all that matters now. It's just a matter of when are they going to do it? And the longer it takes, the more unsettled we're going to be. You know, it's very much, it's kind of the marshmallow test, right? Do we have the patience to play out the probabilities? And as I remind my traders in the Sector Secrets Mastery, trading is not fun and thrills and excitement. It's absolutely discomfort and patience. Nothing about trading comes natural. Nothing about trading really are things that we're trained to do, which is wait, right? We're supposed to do, work, act. Trading actually rewards the opposite, waiting for the right moment. So let's use another analogy. If you're a baseball player and the pitcher is throwing pitches, the market is the pitcher. We are the batter. And therefore we wait for our pitch, right? And sometimes the pitch is going to maybe, hit us in the thigh. And that's what happened on Thursday. So I just want to put that in context. And you can see here, Friday, we recovered very nicely. And frankly, right now, we're pretty much where we started Thursday's sell-off session at. So in a lot of ways, it's a tie ball game again. It's 0-0. So let's get into some questions. If you have any questions, symbols you're looking at, maybe positions you're in, let me know. Type them on in. Let me know what time frame you're looking at as well, and we will go ahead and tackle that. All right, so we got the audio technicalities sorted out. I was glad we could do that. Nothing like a live show. All right. So first question from Mike, who asked, I really enjoy your insight that you're having more winning trades equated to making less money. I really enjoyed your insight that you having more winning trades equated to making less money. Oh, I don't quite get that. How many years did it take before you to figure that out? Having more winning trades equated to less. Mike, could you rephrase that? Because I'm not sure I understand the question, but how much? But I can answer the second part. We have to make. Let's talk about win rates or taking profits too soon. Yeah, if you wouldn't mind, just rephrase that for me, my friend. I want to make sure all of us here in the room can benefit from your question. But let's talk about how many years did it take for me to figure out just trading in general. So basically what we have is it's what we have is a learning curve that we're talking about, right? What all of us have to do when we're starting off anything new. And by the way, here's the insidious thing about trading. The ads do it, right? Start trading tomorrow. All of us here in this room have a vocation, right? And if I were to come to your office and you say, okay, Rag, you're going to learn my vocation. I'm going to sign up to your mastery, right? And you're going to teach me what you do. You're going to tell me, Rag, you're not going to do it well or even right on day one. You're going to learn. And then I'm going to teach you some more and you're going to learn. And you might say, Rag, this might take you about 6 months or 2 months or 5 weeks. I don't know. But on day one, it's not going to be something we're going to get. And for me, the way that I'm addressing how long did it take me to figure out being able, and I'm still looking for your comment, Mike, if you could clarify the question. Again, on the how long does it take? Here's the thing. It took me a little bit longer than it's going to take you. And how do I know that? Because the things that I have now automate all the lessons that I learned. Structure dictates strategy. Strategy dictates indicators. We fine-tune the indicators to read the way that I read the market now after 30 plus years. So if you talk to somebody, the same reason we get tennis lessons, golf lessons, violin lessons, whatever it is, we go to somebody who knows how to do that thing. We say, look, you've already made all the mistakes. Teach me how to do this quicker. And that's what anyone in my position wants to do. But we'll all tell you it's going to take a little bit of time to do it. And that's ultimately the answer I have, in terms of that. But how long did it take me to accept um, the market's going to move at its own pace? How long did it take me to accept, changing my indicators and responding to what I see, not what I think? Frankly, not long. And let me tell you why. Let your losing trades sting a little bit. Let the mistakes that you make in the market, don't sweep them under the rug. Say, oh, I learned a lesson, and this is the tuition I'm paying to the market. No, say that cost me money. It cost me and my family money, and I don't want to make that mistake again. Let that hurt a little bit. And so, no, it didn't take me long to shift gears because I took every single loss as something that I knew, A, I had to understand, and B, not do again. So I will look out for your follow-up to that. And moving on to the next question. What do I think of deer? Fred. Yeah, so not what do I think, right? What do we see? So let's build this up from the bottom of this chart. Starting with, well, actually not quite from the bottom, from our multi-structure. I probably should just put this at the bottom of the chart, because I like to say from the bottom up, from the foundation up. But we are talking about the structure, the energy. The energy in deer is up. The energy in deer is up. So if I have bullish energy, now what do I want to do? I want to find, Fred, whatever indicators you're using. Maybe you're using the top tier pro system, maybe you're not, but whatever set of tools you're using, find the ones you use, first of all, in a trend. And then my approach to trend trading is not buying at a higher high. By the way, Thursday was a perfect example of what happens when we buy at high, when we see a broad group of participants buy at higher highs, not us, not our mastery, not the Sector Secrets room, the Sector Fu Mojo Dojo trading room. But when traders do buy at highs and we end up with sell-offs like we saw on Thursday, that's a lot of people scrambling for the door. And think about what happens. Selling begets more selling. Algos get into the whole action because of the momentum, because of the size, because of the panic, and everything just gets exaggerated. That's really what algos do at a surface level. But deer, let's wait for a pullback. I would like to see something at least to a Darvis level, or 13 EMA may not be a bad way to go. There are a number of levels we could think about with deer. How about just starting with something simple like about 402.5? That's what I would do. I would buy though. I would buy. What is going on with Qualcomm? Again, what do we see? Qualcomm does not have a trend, but much like the analogy of the car going down the highway, the neutral was preceded by an uptrend, which means the car was already accelerating, right? The market was already accelerating. That's the energy. And so now we're coasting. Again, coasting is going to make me question how likely we are to see new highs, but I'm still bullish, right? So my new high expectations going down, but I'm still going to look for opportunities to buy. And I'm going to look for opportunities to buy based on oversold triggers at support. Maybe that support is this Darvis level sitting at 163.75. Maybe that support is going to be the daily price movement range, which is going to update and plot on Monday. Many of you who have the top tier pro system now from last week, and we're going to continue to offer that until Saturday, until this coming Saturday. But many of you have it already know, okay, Rog, I'm going to wait for the daily price movement range to come in focus. And if I can get my secret squiggle to confirm, that's a pretty reasonable buy zone. Wait for the pullback. And then I would focus on the long side. All right. I would focus on the long side. All right. Next up is R, who asked, I bought your 1 month SSM, Sector Secrets Mastery, but there's no indicator for the HPMR or 30 or HDPMR. That I can find. So R, if you bought the mastery, here's what I would tell you to do. 2 things. If you have the mastery, go into the files section of the room. And when I see you in the mastery, Lorna or I can walk you through that. Tomorrow is a text session. Okay. So for anyone who bought the mastery, thank you. You have just entered a room where we're going to talk about trading Monday through Friday, minimum 2 hours a day, day trading, swing trading, and even our investment portfolio, or our portfolio positions, as I like to call them. The HPMR for the S&P, NASDAQ, Russell, and the Dow are in the file section. Daily price movement ranges come with the class. So if you bought the class, that's where the daily price movement ranges come in. Take a look at the packages. I don't want to get into them right now, but we will review them again on Wednesday. So if you haven't already registered for the top tier webinar that we're going to have on Wednesday, I'm going to get into, what are we up against this year? We saw a taste of it on Thursday. How do we manage things like that? How do we thrive in environments like that? How do we not get shook up too badly? What are the algos doing? Heck, what do algos even look for? Why were they kind of complicit in Thursday's action? How do we handle them? How do we manage risk? How do we even lower it? We'll talk about this on Wednesday, 8 p.m. this Wednesday. All right. And we'll talk a little bit about 2024 events. And again, I'll show you some trades that we've got going on. All right. So that is Qualcomm. And question about the mastery. Let's see. Next up is review NTNX for a long-term hold. Okay. If we're going to talk long-term hold, again, barring any so differences in what a long-term hold would be. For a daily time frame, I would focus on long-term being 10 days or above, right? But my window on a daily is usually 2 to 10 days. When I start talking weeks and months, that's going to be a weekly, but you did mention daily. I would focus on what we saw. So I'm going to show you exactly the days that the system would have said buy. All right. And actually, I'll show you the system at work. So first of all, structure, neutral. Neutral structure means, thank you, Secret Squiggle, we got to consult you. This is a bullish environment, but I'm looking for an oversold buy. That's where the Darvis is going to come into play. And you can see where that Darvis would have given us, let's see, this day, and I would say this day here on the 2nd were all tests of that Darvis. But the Secret Squiggle has something to say about that. Let me show you what I mean. So when the Secret Squiggle, and I'm going to highlight this here, when the Secret Squiggle gets down to the low area, which is as close to this green dashed line as possible, what we end up with is the setup. That's the confirmation that right in here, that the Secret Squiggle says, yep, that's the day to buy. And I would tell you, I would either look at this as a minor low, and that would be an entry on the 2nd, but at the Darvis, so you took some heat until we bounced, or use the minor low and get in on the 3rd. So the 2nd or the 3rd is the kind of setup we're looking for. That's the way it should look. That's the timing. And then now, if it wants to have a momentum breakout, that'll be through likely 67.05, but there's no entry at the moment until we come back down to another oversold trigger. All right, next up is Disney. Disney is the best look in XLC. JP, absolutely the best. And we want daily price movement ranges. This is a trend. This is one of the few stocks in the XLC that's a trend. Right now, Google's trending in the XLC. I think there's something else. And Diz. Diz is definitely the one that I like. Scalable, very affordable set of options for the long calls. They had a board meeting or something, some brouhaha last week. A lot of volatility, as we've seen in a lot of other corners of the equities. But Disney is still a buy the dip setup. So focus on the daily price movement range. And by the way, in a trend, I don't necessarily need the Secret Squiggle, but as long as the Secret Squiggle stays above this midline, that is generally a really good bullish, right, overall stance. I'm not going to use it for timing, but if I'm looking at it from the standpoint of sort of the environment that we're in, that would be a really good use of the Secret Squiggle. But I really don't need anything other than green trend, daily price movement range, and or Darvis, or heck, if we get a mean reversion, that's going to be to the lines of the green, yellow, and red, which is our top tier 34 bar mean reversion or wave. That would be the other place to look for Diz for the long side. All right, next up, Ray asked the ES. Okay, let's jump on over there. ES futures are trading up slightly. Yes, they are, after a pretty impressive recovery on Friday, right? Strength on Friday isn't like strength any other day, gang. This is the last day of the week. The closing sentiment on the last day of the week was bullish, right? That's pretty darn impressive in terms of timing even. With the earnings season starting from next week, yep, we're kicking off financials, yes. Will the market shift its attention from the Fed and inflation to earnings? No. Those are two different things. So earnings are very small pockets of volatility. Earnings are not macroeconomics. Earnings are not something, I'm telling you this right now, the Fed does not give a rip what earnings are. The Fed's dual mandate employment and inflation. They will obviously keep an eye on the broader averages. They don't want to see a lot of volatility that's beyond, right now we're not getting much outside, if you will, the historical volatility. But I will say this, no, it's going to be two different reasons for volatility. So look at the long-term trend as being powered by what we expect the Federal Reserve to do, which is cut rates by the July 31 meeting. And then in the meantime, we're going to have these massive volatility events in the individual stocks, but they are two different catalysts. They are not the same thing. So on a single day or two, there'll be an outsized amount of attention in terms of earnings impact on the stock. But after the dust settles, it's right back to the macroeconomic, which is just what is the Fed going to do? Picture, expectations. All right. All right. Thanks for that. Next up is, let's see. I'm a farmer, says Joe. Farmers have made a lot of money. Joe, I mentioned the MOO agribusiness. Deere is moving, CTVA is moving. I'd love to see Moo above the 200. This might be a new trend. I think there's two places, to your point, that a lot of traders might be overlooking with a disproportionate attention on tech. Agribusiness, hey, I'm great. That's great that farmers made a lot of money the last 3 years, bullish on DE. I love it. I love it, Joe. Also, keep an eye on minerals, mining and metals. Mining and metals, keep an eye on GDX, the gold miners ETF, XME. There are some unusual, right? There are some unusual sectors that are not normally in sort of the conversation that are absolutely on the move. Great point, Joe. Great point. Let's see, what else do we have here? Bear with me. Hang on, gang. I can't do customer support. I appreciate you being part of the master. I can't do customer support. This is a market outlook show. If you do have customer support questions, please feel free to reach out to the office on Monday. For obvious reasons, I don't even have access to that back end. So let the folks who can handle that, they'll definitely help you out. Okay. Thank you for the question. Thank you for joining the mastery. Alexander asks, are you going to do Sunday afternoon shows like this? Alexander, we've been doing this show for over a year now. So yes, we will. We do this every Sunday at 6 p.m. All right, next up, oil is looking good. Bill, yeah, would I stick with the sector for trades or find the best breed? Yes and yes. So oil is absolutely in the bullish hemisphere. It's turned into an uptrend. The top tier pro system said it confirmed it, and it has stuck with it since the 7th of March. Here we are on the 7th of April. So 1 month in, good looking uptrend above the 200 green grab candles. It's been a great trend. And to your point, it's going to take with it XLE names, OIH names, and XOP. Those are three sectors, by the way: XLE, energy, OIH, oil services, and XOP, oil and gas explorers. So am I going to go with the sector? If there's liquidity and things like XLE, I'm happy to. But Exxon, Chevron, Schlumberger, those are the kind of names that I've definitely got my eye on. And I'm always looking for relative outperformers because that is likely where the best continuation is going to be. So always, relative performance is always going to be the focus. Bill, yeah, great eye. Absolutely want to stick with oil. That could be also USO, ETF. And I want to stick with the relative outperformers. So some of you might say, Rob, what does that mean? What is Bill asking you? It's a great question. Let me show you what he's asking. When you open up XLE, take a peek here. When you open up XLE, what you have is all of these stocks are moving up. So you might say, well, which ones do we focus on? I don't want to buy all 11. If we can buy XLE because there's the requisite amount of open interest, it's liquid, then I'll focus on XLE because playing the tide when all the boats are rising is an easy way to take advantage of all these names in a single ETF. That's XLE. After that, the reason I single out Exxon, Chevron, Schlumberger is because those three names are not only in uptrends, they're heavily weighted in the XLE. Schlumberger is also heavily weighted in the OIH. There's some really good bang for your buck in two different sectors. And the open interest on all three of those names is excellent. I would also say Occidental and Fang are also very liquid names as well. All right. So Do I teach how to build these indicators in TradingView? Satya, we give you these indicators. That's part of the program. So these are proprietary indicators that I've created throughout my career. These ones we have been testing and for 13 months, and that's what's part of the class. So do we have these indicators on TradingView? Absolutely. And when you sign up for the class, we can activate your TradingView account for these indicators that come with the top tier pro system. Absolutely. We support Thinkorswim, which is what I'm on right now, and TradingView. Those are the two platforms that I use. Not that there aren't other great ones, but those are the two platforms that I use. All right, next up is mRNA. Sure. mRNA, I would be cautious on this one. Perhaps using the 200 might be the way to go on something like that. Look, if I'm trying to prioritize trends, Fabian, I can't say that's going to be at the top of the list. Ditto take two, right? It's not as if there aren't other setups to have. It's not as if pressed, I wouldn't say, hey, here's the setup and take two. But here's a dangerous thing with me doing that. I'm not doing you a service because unless somebody here has unlimited capital and can buy everything that they want to whatever size they like, we have to be discerning with our money. We want it. And even if we didn't, look, Grandpa Buffett has all the capital in the world, and he is one of the most discerning people with his money. He's putting his money into places where he sees the most potential for upside movement, for being able to acquire more ownership and then therefore see that appreciation. As traders, he's not a trader, but as traders, we can learn a lot from that. Is Take Two the kind of name that I would say is likely to keep moving higher? It's not showing evidence of that right now. It is at least breaking the downtrend. It's at least getting above the 200. But as far as the probability of follow through, it's not where I would want to see it, right? For upside follow through. So that's where I take a look at something like Take Two and say, could be interesting above the 200, but I want to be really careful because this stock is not moving with the NASDAQ. The stock is not moving with a lot of other strength names. Now, when it comes to Take Two, actually, let me do this here real quick because I actually don't know the answer to this question. Let's go take a look at ETFDB, which is where I'm going to go do a reverse stock exposure search. All right, where would Take Two be most heavily weighted? XLC. So if I take a look at what's happening broadly in XLC, there's a little bit of weight of Take Two in XLC. It's about 3.33% weighting in XLC. Let me ask you, look at what's moving in an uptrend in XLC. XLC itself, which is sadly very illiquid, Google, Disney, and T. So if I'm trying to focus on where the relative performance is, where stocks that are moving up will likely continue to move up, that's where I would say nothing wrong with it, but it needs a lot of help because it's not even moving with XLC. See, XLC is moving higher. That's the disconnect I think we have to be aware of. But could it play catch up? Absolutely. And if that's the kind of trade you're trying to put on, sure, that would be something to keep an eye on. All right. Next up is, let me grab a couple more questions and we'll call it. Let's see. Momo and 831 a wave. Oh, so Grace. Yeah. So the question here is, Rog, my charts look different than yours. Grace, if you did not know, we are right now in the midst of a brand new re-examining of what's happening at the broader levels of the market. So if you haven't, Grace, here's the best answer. Come join me on Wednesday. It will answer all your questions. The classic tools that I've always used are still fantastic, but they were designed in an environment where we weren't dealing with 0 days to options expiration. We weren't dealing with this massive retail participation or algos. So what we've done is we've gone back to the drawing board, rebuilt this, evolved the process of the traditional tops, and now we have top tier pro. And that's what you see on my screen. But again, come check out, see for yourself, right, on Wednesday, and you'll see what the difference is and what we're doing to take advantage of the reality of what we have going on right now. All right. So as always, thank you so much for being here. Oh, Fred. Yeah, this is an easy answer. I don't use internals. And I don't like to end something on a sort of controversial note, but you know what? You all are here taking some time to learn more about the market. Let's talk about this really quickly. I'm going to open up the SPY. So take your favorite market internal. If you've never thought about the way that it's calculated, please do go Google that. And you might be shocked at the actual calculation of what it is. Most of the time, what you're going to find in a market internal is it's measuring NYSE or it's measuring the S&P, right? And I know a lot of you said she doesn't use them. Let me tell you why. No market internal is calculated to reflect the composition of the indices the way that they are. All right, what does that mean, Rog? Imagine if we're baking cookies, all right? And I said there's sugar, flour, egg, baking soda, I don't know, some kind of extract, and I don't bake. But you grab the 5 or 6 main ingredients. But what if I didn't tell you how much of each? Do we use equal parts of extract, equal parts of egg, equal parts of flour, equal parts of baking soda, equal parts chocolate chip? I mean, it sounds like an egg omelet at this point, right? The proportions matter. The proportions are the dish, right? Now, market internals think that everything's equal weighted, and that's not the truth. The truth is that most indices, I say most, Dow, Nas, S&P, Dow, Nas, S&P are high concentration weighted. Market internals are not. So they're measuring something in a way that doesn't really reflect the fact that Microsoft, Apple, Nvidia, and Amazon have a disproportionate amount of influence on what happens with the S&P, or that financials are factored in really strongly into the S&P. And when you go down that list of 500 names, when you get past the first 20, when you get maybe down to the last 100, they mean little to nothing. And yet the market internals think their movement matters. And frankly, I'm here to tell you, it doesn't. So market internals are simply not measuring. I don't want to say they're wrong, right? That's kind of judgy. What I'm here to tell you is market internals do not measure what we are trading in the way that they are composed. So it's, again, making that cookie with equal parts. I know that's kind of gross, right? I just described what sounds like a doughy chocolate omelet. If everything's equal parts in this cookie, proportions matter, right? And that's really the way that's the way I look at the big no when it comes to our internals. I don't look at them at all. But you know what is the internal? This is. If you want to know what's going on inside the S&P, lift the hood on it. Look under the hood. You'll see it's these stocks. It's the tech sector. It's the financial sector. It's the healthcare sector. It's a little bit of the energy sector. So we want to see it for what it is. So this is your market internal. What are the stocks doing within the S&P or the NASDAQ or the Dow? And it's going to be something that most traders are not going to tell you. But these are just facts, right? Market internals are not measuring the market in the way that they are weighted. And that's a great place to end. And look, gang, it is distinctions like that that make a difference. You might say, Rog, I've never heard that before. Think of what else you're never going to hear of when we talk on toptierprosystem.com for the registration. What are the things that you've been told might be true, but they really aren't leading to the kind of trades you're expecting? We have been doing very, very well in the Sector Secrets Mastery. Hey, all my cards on the table. Last week was not fun, but that's 1 week out of now 13, right? 1 week out of 13. So that's why how to manage risk, how to lower risk. How do the 2024 events play into this trading year? We're going to talk about those things. But remember, a lot of the things that we're told just simply don't pan out to lead us to where we want to go, which is account growth and consistency. And that is really, at the end of everything, what Top Tier Pro System is looking to do. Consistency, account growth. I mean, does anything else matter? In my book, not so much. Enjoy the rest of your evening. Thank you, as always, for joining me for the Top Tier Outlook. I'll see you all tomorrow at 9 a.m. for charts and coffee. Thanks, gang. Take care. Be good to each other.